Welcome to today's Daily Strategy Explainer. It's July 31st, 2026, and we are operating in a market environment where traditional pricing models are, frankly, being pushed to their absolute breaking point. So we're going to strip away the noise today and look strictly at the hard data. We're focusing on the structural impacts of current market signals and exactly what they mean for global asset pricing. If you're managing capital right now, this is the precision data convergence you absolutely need to understand. Let's dive right in. Here is our roadmap for today. We're going to start with macro sentiment, then we'll move into treasury and liquidity dynamics, and dissect equity microstructure. After that, we'll cover sector rotation, filter for institutional insight, and wrap the whole thing up with the strategic action plan. Starting with Section 1, Macro Sentiment and Foundation. Look, the era of central bank transparency, it's over. We have officially entered a paradigm of data-dependent mystery, where reevaluating the cost of capital is completely hijacking the market narrative away from your traditional growth stories. To understand this new reality, we just have to look at the latest FOMC meeting. The Federal Reserve held the policy rate steady at 3.50% to 3.75%. But the internal mechanics of that decision were fascinating. It was a highly unusual 9-3 divided decision. Regional Presidents Logan, Kashkari, and Hammack actually formally dissented. They wanted an immediate 25 basis point hike. Meanwhile, Fed Chair Kevin Warsh offered virtually zero forward guidance, just throwing out a vague, "we will not hesitate to act." The result? The market is now flying totally blind, forced to react to every single data print in real time. And you can see that anxiety in the numbers. Despite the official hold, the market-implied probability of a September rate hike immediately shot up to roughly 63%. That is a massive credibility discount. Institutional capital is basically pricing in the reality that the Fed might be way behind the curve on controlling inflation, completely ignoring the chair's neutral stance. So, we have to cross-validate that market skepticism with actual hard data. Headline PCE is sitting at 3.7% and core PCE is at 3.3%. On top of that, the Q2 Employment Cost Index jumped 0.9%, which tells us wage-driven inflation is still incredibly sticky. Now contrast that with overall Q2 GDP, which was really sluggish at just 1.5%. But here is the critical signal. Equipment investment surged by a massive 15.2%. This extreme capital expenditure, which is driven almost entirely by AI infrastructure buildouts, is practically the lone engine keeping the real economy afloat right now. It's like the entire slowing economy is balancing on a single pillar of highly concentrated tech spending. Moving on to Section 2. Treasury and liquidity dynamics. We're talking about the critical plumbing of the financial system here. Right now, the foundational strength of global capital is being severely stress-tested by rapid liquidity extraction. To put this into perspective, the Federal Reserve's reverse repo facility, the RRP, is practically running on fumes. It's sitting at roughly $100 million right now, following a routine $30 million test operation. Remember the 2020 to 2023 era? During that peak, this facility held over $2 trillion. That massive liquidity buffer, which basically cushioned the entire system against heavy Treasury issuance, is now 99.99% gone. Now contrast that drained RRP buffer with the Treasury General Account, the TGA, which has been aggressively rebuilt to over $970 billion. A very stark reality emerges here. When the Treasury is busy filling the TGA, and the RRP is empty, that cash has to come from somewhere else. Where's it coming from? It's systematically extracting liquidity directly out of commercial bank reserves. Capital is quite literally being vacuumed out of the system. And we are seeing this liquidity drain instantly validated in the bond market. The 10-year yield has pushed up to 4.74%, which is high, but the massive red flag is the 30-year Treasury yield hitting 5.28%. That's a 19-year high. The long end of the curve is absolutely revolting. It's flashing a massive warning sign about deep structural concerns over long-term inflation and the sheer, overwhelming supply of fiscal debt hitting a market with shrinking reserves. Which brings us to Section 3, Equity Market Microstructure. To survive in this market, you have to understand how traditional asset correlations are just completely breaking down under the weight of mechanical flows and heavy derivatives trading.
Take the recent 17% intraday spike we saw in the Kospi index. If you look purely at the mechanics, this wasn't driven by fundamental, real money investors buying into some glorious economic recovery. No, this was a textbook forced short covering event, culminating in a massive gamma squeeze. Hedge funds that were over-leveraged on the short side were forced to buy. that pushed market makers to aggressively buy the underlying asset to hedge their options exposure, creating this wild, artificial, explosive feedback loop.
And the engine driving these explosive loops? It's 0 days to expiration, or 0 DTE options. They now account for a staggering 65% of S&P 500 options volume on the CBO. The structural dominance of these hyper-short-term derivatives forces market makers into extreme rapid-fire delta and gamma hedging. It artificially inflates intraday volatility. So the price action you see on your screen, it often has absolutely zero connection to underlying economic fundamentals. The tail is truly wagging the dog.
Section 4. Sector rotation in alpha. With fundamentals somewhat decoupled from index-level volatility, how is capital actually allocating at the sector level? Well, we are seeing a massive strategic divergence, especially within big tech.
Let's be real, the market is ruthlessly punishing and rewarding capital expenditure right now. On one side, Amazon raised its 2026 AI capex to an eye-watering $220 billion, backing it up with proven AWS growth. The market loved it and rewarded them with a 15% surge. On the flip side, Apple essentially refused to engage in that level of AI infrastructure spending. Combine that with their supply shortages, and they were punished with a 9.3% drop. The new fundamental divide in tech is entirely based on who is successfully building and monetizing AI infrastructure.
Because of this severe dispersion, the institutional flow logic becomes crystal clear. Hedge funds and active managers cannot just sit back and rely on passive, broad market beta anymore. They have to hunt for alpha using relative value, low net strategies. The AI trade isn't just a fun, futuristic theme anymore. It has shifted entirely to fundamental earnings delivery. You have to go long on the proven infrastructure spenders and strictly short the laggards who refuse to adapt.
Let's look at Section 5, Institutional Insight. As analysts, we have to filter out the incredibly loud socio-political and geopolitical noise of today's environment so we can extract purely objective, actionable economic indicators.
For instance, the news is dominated by highly charged political events right now. Think of the lawsuits surrounding pandemic-era business closures like the Marsden lawsuit or the intense municipal and police turnover causing gridlock in Seattle. As capital allocators, we must impartially translate these events into strict data points. What are they actually telling us? Well, they signal deeply scarred consumer sentiment and a severe fracturing into a K-shaped economy where the bottom is literally cracking. When you see a 50% one-month jump in rent delinquencies alongside small business gridlock, that is a hard, undeniable economic signal of consumer distress and massive ongoing threats to commercial real estate. You have to ignore the political noise and trade the data.
Section 6, Strategic Action Plan. Based on this incredibly complex convergence of data, here is exactly how institutional portfolios need to adjust today.
We've mapped out two concrete scenarios. Scenario A is your bullish case. If market forces somehow compel the Fed to cut rates, and all this AI capital expenditure quickly translates into clear earnings, you need to heavily overweight specific AI infrastructure winners. But Scenario B is the bearish reality we absolutely must prepare for. If the 10-year yield sustains above 4.75% and the TGA continues to aggressively extract liquidity, active managers must execute strict, aggressive gamma hedges. Broad market beta is not going to save you in a liquidity dry-up.
And finally, Section 7. Let's get to the final verdict for this strategy explainer. Our objective, strictly data-driven rating for today, is neutral to bearish. The market is violently caught between two opposing forces right now. On one side, you have unprecedented, highly concentrated AI capital expenditure. On the other side, you have a dangerously tightening macro liquidity environment. This massive friction demands highly tactical weighting and incredibly defensive alpha hunting.
I want to leave you with a final provocative thought. The ultimate black swan tail risk you need to be monitoring tomorrow. The RRP is empty, the Treasury is vacuuming up reserves. If the TGA absorbs the very last of our excess banking liquidity, what exactly happens to global equities when that massive zero DTE gamma loop we talked about abruptly reverses and there is literally no liquidity left to catch the fall? Keep a very close eye on the data, folks. Thanks for joining this explainer, and we'll see you next time.